In this case, I'm assuming that purchase price of the home is $750,000. So to buy a $750,000 home, the minimum down payment required is $50,000. For this example, I'm assuming that we are putting 10% of the purchase price, that is $75,000. So on the basis of this minimum down payment, the mortgage default insurance would be around $20,925. So when you are putting less than 20% down, you have to incur the cost of mortgage default insurance. This insurance premium gets added to your mortgage required. So in this case, the total mortgage that we require is $695,925. Interest rate, I'm assuming it to be 5%. So when the interest rate is 5%, the minimum qualifying rate would be 7%. So as per the mortgage stress test, the lender makes you eligible on the rate that is 2% more than your actual contracted rate, or 5.25%, whichever is higher. So in this case, your qualifying payment would be around $4,874. Amortization, I'm keeping it 25 years. And for an insured mortgage, it cannot exceed 25 years. So monthly housing cost comprises of your property tax and minimum utilities, which a lender considers while approving your mortgage. And your actual mortgage payment, that is your principal plus interest payment for this mortgage, would be $4,047.53. So after inputting all these figures, this calculator is showing us that the minimum income or the ideal income you require to buy this home of $750,000 with $75,000 of down payment for around $169,019. So I am assuming that we have the same income. So I'm just rounding off to the next number. I'm putting $169,100. So just have a look over here under the GDS, that is gross debt service ratio. So a lender calculates your eligibility on the basis of two major ratios. One is GDS, that is gross debt service ratio. So the GDS ratio includes your monthly housing cost, which includes your mortgage payment, your property taxes, your heating, or 50% of the condo fee if you are buying a condominium. So as per the mortgage standards, your total monthly housing cost, that is GDS, should not be more than 39% of your gross household income. And particularly when it's an insured mortgage, that is where you are putting less than 20% down, it cannot exceed 39%, because the mortgage default insurance providers such as CMHC have set the limit that they will only be approving for the mortgage default insurance where the GDS is less than 39%. So now with this income, we are good with the GDS since it is lesser than 39%. Now let's come to the second important ratio, that is TDS, which is total debt service ratio. So as per the mortgage standards, your total monthly debt should not be more than 44% of your gross income. So what TDS includes? It includes all of your housing costs, including your mortgage, utilities, property taxes, and on above of that, whatever your car loans, your credit card balances, lines of credit, student loans, or any other debt you have, combining all these debts, it should not be more than 44% of your annual gross household income. So now in this case, it is sitting at 38.98%. It means even if we have any monthly debt payment, we can still be getting approved for this mortgage of $695,925. Let's assume in this case that you have a car loan payment of $500 a month. So under the monthly debt, I'm going to input $500. So even after putting $500, the TDS is coming out to be 42.53%, which is well within the mortgage standards, that is 44%. So this example proves that if you are going for an insured mortgage, even if you have a monthly debt, or as per this example, a car loan of up to $500, you can still be getting approved for a mortgage. But here I just want to give you a heads up. Although as per the mortgage standard, you will be getting approved for a mortgage because your ratios are below the mortgage standards. But a higher TDS ratio means you are increasing the risk of taking on more debt that you can afford. Always keep yourself well below your maximum limits. Never stretch yourself to the maximum what you can get approved for. Because in the future, your housing costs can increase with the increase in the property tax in future, with the utilities or other repair and maintenance that you will be undertaking for the property. So where you are putting at least 20% down, it is called a conventional mortgage. So here in the down payment, I am assuming that we are putting actually 20% down, that is $150,000. So now see, with $150,000, there is no mortgage default insurance premium that you need to pay. And the mortgage that you require to buy this home is $600,000. I'm keeping the interest rate and the amortization as it is as per the last example. So now with the only change in the down payment, you can see the ideal income that we need to buy this home is $148,346. For this example, I'm assuming that we don't have that much of income. And let's suppose that our household income is $140,000. So I'm going to input here $140,000. So now if you can just come down here and look at the GDS. So GDS is 41.32%. Cannot be more than 39% in case it's an insured mortgage. But when you are putting 20% or more than 20% down, in that case, a lender may still qualify you for a mortgage, even if your GDS ratio is slightly higher. Again, mentioning here, a higher GDS ratio means you are increasing the risk of taking on more debt than you can afford. But if you're stretching yourself to the maximum of your budget, then it can happen. Now we take the same example as previous, that we are having a $500 of car loan payment. So I'll just input $500 over here. Just have a look at the TDS. Now with this $500 of monthly car loan payment, the TDS is now surpassing 44%. In this case, it is coming out to be 45.61%, which is going above the mortgage standard of 44%. And even the lender might not be comfortable to approve $600,000 of mortgage with this higher TDS. What's going to happen in this case? So two scenarios can happen. First, the lender will be approving you with the lesser of the mortgage if your annual income is going to stay as it is. So if I'm keeping my down payment the same, which means I have to reduce my purchase price. So I'm just reducing my purchase price by $30,000 to $720,000, for which now the mortgage that we require is $570,000. So now if you see, with the reduced amount of the mortgage, the TDS is coming well within the standards, that is 44%. Now you can get approved for this mortgage of $570,000, which means a car loan of $500 has now reduced your borrowing capacity by $30,000 in this case. Or we can take the other scenario. If you still want to buy a house of $750,000, what you need to do is you need to increase your down payment. So from $150,000, at least you have to put $180,000 so that the mortgage required can come down to $570,000. So in a conventional mortgage, where you are stretching yourself to the maximum of your limits, a car loan payment can actually affect your eligibility to get a mortgage. In this video, I'll explain you how to use the Mortgage Affordability Calculator sheet of this home buying planner. So this sheet of the home buying planner helps you to know what is the maximum purchase price of the home can be based upon your income, down payment, interest rates, amortization, and the housing expenses you have. I'll start with the annual household income. So make sure that you input your gross income, because any lender calculates your eligibility to get a mortgage on the basis of your before tax income, not on your net income. Let's suppose our household income is $130,000. As the interest rate and amortization were already inputted in this calculator, so see on here, the calculator is already calculating the maximum purchase price. And on the basis of this purchase price, it is telling that what is the minimum down payment required to buy this home. But here you see in this calculator, it is showing some invalid values in 6 of these fields. Why? Because we haven't inputted the down payment here that we will be inputting to buy the home. As soon as I input the down payment that I'm looking to put, the maximum purchase price has been updated to $537,000. This was a question of one of my clients, that why this maximum purchase price has got updated. That's why, because when you buy a home, there are two components of funding. One is your down payment, other is the mortgage that you'll be getting from a lender to buy that home. So that's why the formula of purchase price is your down payment plus mortgage. Now, the other thing here is, even after inputting the down payment, some of the cells are still showing the invalid output. That is why, because if you see on the basis of this maximum purchase price, which the calculator has calculated, on the basis of that, the minimum down payment to buy a home is $28,719. If the minimum down payment to buy the home is $28,000, how can we buy a home with only $25,000? It means we have to increase our down payment if we want to buy the maximum purchase price calculated by this sheet. So now what I'm going to do here is I'll be rounding off to next number. So if it says $28,719, I do here $30,000. As soon as I put $30,000, all the values which previously were showing as invalid, now it is showing the complete data. Now what it shows is, on the basis of this income with $30,000 down payment, at this rate of interest with this amortization, and this house with these housing costs, that is property tax and utilities, this is the maximum purchase price of your home can be. That is $542,188. Since we are putting a minimum down payment, that is $30,000 to buy this home, the mortgage default insurance that you have to pay is $20,488. So what happens is this mortgage insurance premium gets added to the mortgage required. So together, the mortgage amount you need from a lender to get approved is $532,676. I can show you with another example by taking some higher household income, assuming the household income is $250,000. Now, if you see, on the basis of $250,000, the maximum purchase price calculated by this calculator is $1.09 million. Now, to buy this $1.09 million, the minimum required is $84,000 as per the minimum down payment requirement rules. So, our down payment has to be at least this much or more than that. I assume that I am looking to put $100,000 to buy this home. So when I input $100,000, again the sheet will be doing all the necessary calculations, like what will be the mortgage default insurance to buy this home, what will be the total mortgage required to buy this home, and what is going to be the monthly mortgage payment. Another question that one of my client was having about the monthly housing cost. So when a lender makes you eligible for a mortgage, it only considers into three types of housing cost. One is your property taxes. So now, what amount you should be putting under the property tax? So for property tax, if you have a property in mind for which you already know what is the monthly property tax gonna be for that one, just randomly input that amount. If not, then what is the criteria for getting pre-approved for a mortgage is whatever the purchase price of your home is. So in this case is around $1.16 million. Do 0.65% of that home divided by 12. So that comes out to be the monthly approximate property tax which a lender considers to make you qualify for a mortgage. The actual can be lesser than this one as well. So what I'm going to do is I'll be putting, let's suppose $600 as a monthly property tax. So see, as soon as I input the property tax, the maximum purchase price has further reduced because as higher the monthly housing costs we have, our eligibility for buying a home can be reduced. Utilities, on the lower side, I have considered $200 because a lender never considers your actual utilities. It takes a standard amount per month to make you qualify for a mortgage. Now we come on the monthly debts. So your monthly debts also become part of the eligibility of your mortgage. So your monthly debt has to be under a certain limit to get approved for a mortgage. Let's assume that we have a monthly debt of $500. So see, with $500, there is no impact on the maximum purchase price. Why? Because as per the mortgage rules, the TDS, that is total debt service, should not be more than 44% of your annual household income. So since it's below 44%, you are good to buy this home even with this debt. The other thing you can do with this sheet is you can prepare your monthly budget and see whether this maximum purchase price comes under your affordability or no. Now to start, what you need to do is on the left hand side, under the column of the tax rate, you need to input the tax rate under which you comes. So let's suppose your tax liability is coming under 30%, that you come under the 30% bracket. As you enter 30% over here in this column, the calculator will calculate your monthly net income. Otherwise, you can always change this tax rate to bring this in line with whatever you are actually getting on per month basis. Now here your monthly income has been set. Now what you need to do is here on the right hand side, start inputting your monthly expenses. So if you see, it is giving the snapshot that after a monthly net income of around $14,500, you are having a living expense of around $3,650. The monthly debts are at $500. The monthly housing cost of $800. The maximum monthly mortgage that you can pay is $5,889, even after getting a maximum purchase price of this amount. So you'll be left with around $3,700, which is quite a decent amount, even if you buy a home of $1.1 million with the income of $250,000. So this was about how to use this calculator. So this calculator is very easy to use. In the left-hand column, if you see, we just need to enter the values. For this example, I'm assuming we have a mortgage of $525,000 at the interest rate of 5%. Amortization I'm selecting as 25 years. For a term of 3 years, I'm assuming it to be 3-year fixed loan. So for this amount of the loan, your monthly payment is going to be $3,053.43. And at this interest rate, what is the total interest that you're going to pay over the lifetime of the mortgage? It's around $391,000. So the very first method is rounding off your payment. So in this example, your monthly payment is $3,053, which is close to $3,100. So what you can do is, you can just round it off to $3,100 if you can. So difference is around $47, which means with every monthly payment, $47 on and above of your mortgage payment will be added to your principal balance. So here I have already inputted $47. Payment interval means the frequency that we want to set for this extra payment. So since we want to pay it with every monthly payment, so I'm just inputting 1 over here, which means now instead of $3,053, each month we are going to pay a round figure of $3,100. And by rounding off your monthly payment to $3,100, total interest saving over the period of mortgage will be around $13,229. And here if you look at the number of payments, it has reduced by 8 payments, which means you will be able to pay off this 25 years mortgage 8 months before. So see, just by rounding off your mortgage payment, you can save this much of interest. Now let's move to the second effective method to pay down your mortgage early, which is converting your monthly payment to accelerated bi-weekly payments. We also call it as the rapid bi-weekly or weekly payment. Here, I would just like to clear the difference between a bi-weekly and a rapid bi-weekly payment. In a bi-weekly payment, you are not paying anything extra. Now the total payments you are supposed to make in 1 year, that are just divided by 26 equal payments. But in accelerated bi-weekly or the rapid bi-weekly payments, you make 1 monthly extra payment in 1 year, which helps you to pay down your mortgage faster in the longer run. How? Let's see with this example. So as soon as I select accelerated bi-weekly over here, so just have a look. Now your payment would be $1,526.71. So by changing this payment frequency, interest saving is $62,442. And just have a look over here. You will be able to pay off your mortgage around 3.5 years early as compared to 25 years. So just have a look what a bigger impact changing your payment frequency has in saving you thousands of dollars of interest. Now here, if you can just make one smart move and bring in the previous method that we discussed in this one as well, like rounding off your mortgage payments, it will have further interest savings for you in the lifetime of the mortgage. How? Let's see with this example. So now accelerated bi-weekly payment is $1,526. If you further round it off to $1,600, let's see what the impact is going to be. $1,600 means you will be paying additional $74 with each bi-weekly payment. So I'm going to put $74 in the interval since we will be paying with each payment. So I'm putting 1 over here. So the interest savings, which previously was $62,000 with changing the frequency, have now increased to around $91,654 by further rounding of the payment to $1,600 bi-weekly. So if you can club both these things, it will have further savings. And just have a look here. What will be the time saving over here? The 25 years mortgage will be paid off in lesser than 20 years. Now let's jump to the third simple and effective method to pay off your mortgage. That is to make 1 extra monthly payment in each quarter. Let me show you how impactful it will be to pay off your mortgage earlier. So I'll just put here $3,053. So we have to pay this payment after 3 months, that is quarterly. So I'm putting over here 3. So if I just show you here in the amortization schedule, so this table has automatically applied this $3,053 payment after every 3 months automatically. So if you make 1 monthly payment extra after 3 months, the interest that you are going to save on this mortgage is $164,159. And you will be able to pay off your mortgage in 15.5 years as compared to 25 years. So if you want to pay off your mortgage as early as possible, this is one of the fastest way with which you can be mortgage free. Now let's move to the fourth method, that is to make occasional lump sum payments to your mortgage. So every lender provides you with some prepayment privilege with which you are allowed to make certain prepayments in 1 year towards the principal of your mortgage. Most of us get some unexpected income in a year, whether it's any monetary gift or profit, or whether it's a bonus that you get from your employer. So what you can do is, you can apply some of these unexpected income towards prepaying your mortgage. So let's take an example in this case, that person receives a bonus of $8,000 each year from his employer. He decides to apply $5,000 out of those $8,000 towards prepaying his mortgage each year. So what I'm going to do is, under extra annual payment, because he has decided to pay each year a fixed amount, that is $5,000, I'm just going to put this amount. As soon as I put this amount, so just see here under the extra payments column, this table has automatically integrated $5,000 at the end of every 12th payment. So with this annual payment, the total interest savings would be $87,626. And this mortgage can be paid 5 years early, that is in 20 years. If you don't want to commit a fixed amount each year, what you can do is you can just remove the amount from here, and here under the additional payment, let's suppose you have plans to put $5,000 on a particular date, you can just simply put amount over there as a one-time payment, and simultaneously you can here see with this chart how much interest savings would be there with each extra payment that you are putting as a lump sum. Now the last and the final method to pay off your mortgage early is take a mortgage for the shorter amortization period, or if you have an existing mortgage, refinance it to shorter term. The effect of shorter amortization period would be you'll be having larger regular payments, but due to larger regular payments, the interest that you'll be paying over the lifetime of the mortgage will be lesser. So if you see for this $525,000 mortgage for 25 years, the total interest you would be paying over the lifetime of the mortgage is $391,026. But if you just take this mortgage for 20 years, or if you have this existing mortgage refinance into 20 years, the total interest that you'll be paying in the lifetime of the mortgage is around $302,976, which means a saving of around $88,000 of interest. So these were the 5 most effective and the simplest way with which you can plan to pay down your mortgage effectively in the longer run. You can also use this advanced mortgage amortization schedule for your mortgage to see what will be the impact on the total interest savings if you apply one or more than one methods collectively. I'm providing the link of this planner in the description of this video. And if you like this video, do subscribe to this channel for more knowledgeable content in the future as well. Thank you.